Welcome to our webinar, Multifamily Outlook 2025, Navigating Market Disruptions. Hey, this is a hot, dynamic topic. John Winnick has put together a great panel of experts. You are definitely going to enjoy this webinar, John. I've enjoyed working with you. What I enjoyed, John, is you bring in these amazing experts that break it down into bite-sized consumption that we can understand. So I'm really looking forward to this because I have to confess my knowledge about this is horrible. Neil Freeman, Aries Capital's here. Ryan Welsh, PNC. Rajin. I know we went through this, Rajin. Chatri. Not even close. I apologize. Right. Akara Partners, though, I got that. And John Winnick, Clark Street Capital. Rajin, I apologize for butchering your name. Hey, I got a couple of housekeeping things. We want your questions. Put them into the chat box, and Anna will get those to John, and he will ask them. Also, we're going to have a couple polls. Those are also in the chat box, and go ahead and put your answers in there in the team's dashboard. And John, this is a timely, great topic, and I'm going to stop talking, and I'm going to turn it over to you. Thanks, John, Clark Street Capital.
Thanks you, Bob. Thanks, Anna and the Coleman team for putting together another wonderful webinar. Well, let's get right into it. Next slide, please. So the multifamily market, one of the more favorable aspects is, here's a chart on how the average monthly payment has changed since 2020 versus how much multifamily rent has grown. So you can see since 2020, given a 3.1% mortgage rate to today's 6.8%, probably a little less now, it's probably closer to 6%. But you can see that the payment has effectively doubled since 2020, while multifamily rents are up about 20%. So, the rent-own dynamic is very favorable for multifamily as an asset class. Next slide. And obviously, you could see that construction peaked in 2022. So there was an awful lot of new multifamily. Some of that product is coming online now, but that has basically grinded to a halt. And new construction multifamily is slowing down considerably. On the next slide, you can see how the supply is impacting rent growth. And it's interesting as you look at the 5 major regions. If you look at, say, the South, for example, 3.7% growth in inventory and basically negative rent growth. And if we take, say, a market like the Northeast, the inventory has only grown by 1.3%. And the rent growth has been positive. So, in the older parts of the country, the Northeast and Midwest, you're still seeing multifamily rent growth because the inventory has not grown as much. Next slide. On the credit side, certainly we are seeing an uptick in multifamily delinquencies, but they're still fairly low. This is from Freddie Mac, and you could see delinquencies have moved up a little bit, but they're still fairly low. Finally, this is actually came from Ryan on our panel, but Ryan, this is the all-in rate for a multifamily loan that you're quoting today?
These are 10-year Fannie Mae rates at the high end of their pricing grid. So it's kind of that pricing can come in from here, but this is a good show where we've been and where we are currently relative to each other.
It's almost 200 basis points from 7.25 to kind of where we are now. So not an immaterial relief that we've seen there.
Absolutely. Still, we're up 200 basis points where we are today versus where we were kind of at the peak of the multifamily market, which Fannie Mae kind of classifies as Q1 2020 from property values standpoint. So,
well, let's get right into it with a poll question. trying to get a sense of market sentiment here. What is your outlook for multifamily investments or lending? Because we have both investors here and lenders here in 2025. Is it the question will be in the chat function, Anna? Or, sorry.
Yeah,
to the chat function. Chat. Here it is. Showed up. Highly favorable, moderately favorable, neutral, moderately unfavorable, and highly unfavorable. Give a second for people to vote.
Awesome. It looks like people are finding it, and you can see the results in the chat, and they'll also share when the poll is closed.
I'm not seeing any votes yet. Are you seeing it on your side?
Yeah, I see 23 responses on my side. I will close it in a second, and it should come up. Right now, we're getting mostly neutral, though, but let me close it.
I can't see the results. Maybe if you could just read them for us.
Okay, yeah, definitely. So highly favorable was 0%, moderately favorable was 40%, neutral was 40%, moderately unfavorable was 20%, and highly unfavorable was 0%. So we didn't have any extremes on either end, but mostly favorable.
What do you all think? What's your outlook? Rajan, why don't we start with you?
I think it's favorable from where we are today, from a place that I think has been, from a transaction activity perspective, has been very low on when you look at any kind of year-over-year graph or long-term graph. I think next year there's going to be, at the end of this year, we're seeing price discovery. I think there's a lot of money in the sidelines that needs to find a home. I think people have been sitting on the sidelines for a little too long, and we all know, that people need to put money out to create value for themselves and their businesses. And so I think there's the price discovery is happening. People are understanding where market clearing prices are, and I think you have a lot of money on the sidelines that need to put money out. And I think rates coming down, of course, from that chart you saw, whether it's 100, 150, 200 basis points on rate is significant. It's meaningful in our world. So I think favorable next year from where we are today.
Yeah, what do you think?
So I would agree with Rajan. I said moderately favorable. I think there are a lot of dynamics that are positive. First, there's low new supply. I think deliveries in 25, 26, and 27 are going to be low because interest rates were very high. Secondly, I think there will be an ability to buy existing product at some meaningful numbers below replacement cost, which hasn't happened for a while. And that's because we're coming out of high rate environment. There are a lot of lenders that are losing their patience, and sellers will have to raise equity or sell properties. So I think the combination of being able to buy at a better than cost, better than it's been for the last few years, and be able to raise rents because supply is going to be low, I think the dynamics are favorable.
Brian, as a lender, what are you seeing?
I'd like to say highly favorable. I think the one exception to that might just be the bank lending. I think there's the banks probably aren't going to be as active as they were in, say, early 2022 for a couple reasons. For one, loans just haven't been paying off as quickly as I think people had hoped. Construction loans are exercising their renewal options and extending, just as we kind of have the market discovery on values. So certainly we've expected more payoff than we've had. I think some of the banks are still wrestling with office, and also deposits are down in a lot just because of with where the Fed funds rate were. I think money market accounts took a lot of deposits away from the banks. So I'm not sure that has been any increase in allocations across banks to lend more, but certainly the permanent market is very favorable. Fannie and Freddie, they both have allocations of $70 billion each. That's set by the FHFA as a cap. Both are going to be well below their caps this year. I think Freddie's done more than Fannie this year. I'd heard, but it was about a month ago, I think Fannie had announced 30 billion closing year to date. So, a fraction of what they've been. I think it's down 20-30% from last year, which was down from the year before. But things have certainly picked up. The run rate at times this summer and in the spring was $100 or $200 billion in new applications at Freddie Mac that were signed up and into underwriting. And as of a couple of weeks ago, I was told that they had 3 weeks in a row of $2 billion signed up. And I was told they've hit $2 billion in a week before, but never 3 weeks in a row. So that's kind of really speaking to the volumes that we've seen recently. A number I heard was they saw $9.5 billion in 1 week in new applications come in for quoting, so not signed up. So the agencies are certainly busy. And I think life companies maybe not as competitive as they've been in the past, but with the new allocations coming up here at the beginning of the year, they're certainly still in the market. And CMBS is very active and has a huge appetite for multifamily properties.
Yeah.
So I think very favorable, certainly from the perm market. Construction lending might be a little bit muted, but I think that the fundamentals are teeing up from everything else that was said earlier for banks to still be interested in lending in multifamily.
Well, it sounds like it goes hand in hand, right? So the more successful, Ryan, lenders like you are in getting construction loans off to the permanent market, the more availability is for banks to make new construction loans. Rajan, I don't know if you've been in the market recently on construction loans, but could you give us some color on what sort of terms and conditions banks are lending on multifamily today?
Yeah, it's certainly not as liquid as it once was. I think the deals that we're in the market with are larger in scale, and so typically, they're being we're getting quotes from the debt fund marketplace. Some of the banks we've done business with are also quoting, albeit the size of the loan becomes somewhat of an issue with how much they can hold of construction loans on their balance sheet. And so we've been in the markets. I think the spreads are pretty similar, to be honest, to what we've seen in years past, maybe slightly up 25-50 basis points. The term is very similar. Of course, when you're borrowing floating rate paper, the rates are just very high. And now they've come down a bit because the Fed has just decreased rates 50 basis points. So that's really good. But really, floating rate debt is still very high. I'd say the stuff we were seeing quoted before this latest drop was in the 8 to 10% range. I would say now, maybe down 50 basis points from there, but that's kind of where we're seeing the range on the stuff that we're out in the market with.
And what advance rate is that? Are we talking 40% down? I mean, obviously at the higher coupons, it's hard to make the deal work.
It's really, yeah, I would say it's debt service coverage driven, albeit, sometimes in the debt fund world, that's not necessarily always the case. But I would say it's anywhere between, on the stuff we're looking at, 55% leverage, and we've seen it as high as 75, even 80%. There's a lot of people that used to play in the equity space that are playing in the subordinate debt space today, and they are playing in construction. And so whether that is a loan that is then attaching itself to or to a subordinate debt, pref equity or mezzanine slice to get up to that leverage, or one fund that's doing it all and then maybe selling an A note behind the scenes. But ultimately, we're seeing the same kind of leverage that we've seen in years past. It's just much more expensive. And the question is, does the property, metrics, can it support it? Can it support that level of debt? And so, but that we're seeing similar leverage, similar credit spreads.
Neil, are private lenders filling the void, and how would you describe how they're differentiating themselves? Maybe if you can give us some color on advance rates and so on.
Sure. So I would agree with a lot of what Rajan said. The banks have, first of all, the big banks have not been lending on real estate. They've lent to REITs, et cetera. So they've pretty much been out. The mid-sized banks that do real estate, a lot of them have had some issues with the regulators since since three banks went broke in the last couple of years. So it's been smaller banks. Their rates have been, let's say today, after the drop, maybe you're 7.5 to 9% on a bank rate. However, they their leverage is usually 50, 55, if you're lucky, 60% leverage. And then a lot of them want 10% or more in what they call a relationship deposit. So as a result of that, a lot of people have gone to debt funds. First of all, as Rajan said, a lot of banks want to stay below 25 million on their books. So they have to syndicate. A lot of debt funds will go, from 25 to 100 million. Some will go to 200 or 300 million. The debt funds typically are pricing somewhere around 10, 11%, sometimes 12% rate. So the rate's higher, but they don't have a relationship deposit. And the advance rate, instead of being 50 to 55%, could be, again, 65 to 75%. So a lot of people, if your deal doesn't work at those numbers, don't build, and then there isn't as much construction. But not only for new construction, but also taking out construction loans so that borrowers don't have to come up with new equity. A lot of debt funds have been putting out money on multifamily.
I mean, so it sounds like when you factor in the compensating deposits, private credit isn't much more expensive.
Yeah, again, a lot of people have gone to private credit in the short run. Now, I think, as you mentioned, with Ryan doing all of this permanent financing, that may free up bank balance sheets, and they may get a little more competitive, especially with the deposit requirements.
And so, Ryan, so just to expand what you said earlier, sounds like there's a big increase in activity. Could you just give us kind of a typical deal today, what the agency terms would look like?
Yeah, I think so the agencies, we're more often than not, just given where the relationship between rates and cap rates are right now, we're going to be debt service coverage constrained. The agencies will typically underwrite to a 125 debt service coverage on a 30-year amortizing calculation. Those rates today at a 125 debt service coverage, and depending on the cap rate, that gets you anywhere between 65 and 75% LTV typically. The agency parameters are up to 80% LTV. But like I said, we're just not getting there that often. Rates we've seen a steepening of the yield curve recently, but pretty much across the board between a 5, 7, and 10-year fixed rate loan, depending on leverage and loan size, you're anywhere between, say, 4 3/4 up to 5.5, maybe 5 3/4 for smaller loans. And again, that's a 5, 7, and 10-year fixed rate loans.
So in most cases, are you, I'd love to hear what percentage of your deals are cash in refinances. I would imagine there'd be very few cash out refinances today. I mean, can you give us some color on that?
Yeah, well, I think, most of the loans that we are doing are actually with cash out, but often those are loans that were done 7, 10 years ago and now are coming up for refinance. So we've had a lot of cash flow appreciation over that duration. We are seeing a lot of newer construction loans recently stabilized or currently stabilizing properties that in a lot of cases the developers had intended to sell the loan and now they're looking to hold on to it for another year or 2 or 3 just to see where the acquisition markets comes. Their construction loans are maturing or requiring a pay down for an extension, and so they're coming to the agencies to lower their rates from the 7-8% floating rate into the 5% agency range. And to answer your question, an aggressively underwritten construction loan that was done at probably 65-70% of cost, or maybe higher, say in 2000, underwritten in 2001 to an exit rate of say 5.25 or lower in some cases, those loans are close to cash neutral today, maybe a small cash in on those. And that's certainly better than where we were a few months ago, because I think if you look at the relationship with the debt service coverage, the 100 basis points or so lower rate that we have today has resulted in about 10% more proceeds. So we're a lot closer to cash neutral than we were on those deals. But that's where we sit.
Yeah, I'd say in the last 2 years, there were a lot of cash in refinances where people had to come up with money. Just wanted to mention one thing. There are some legitimate mezz and pref funds that will go behind fixed rate loans, including agency, and lend another 10% or so, go down to about a 110 debt coverage from the 125. So you can maybe get another, if Ryan's at 65%, you might be able to get another, say, 10% in proceeds.
So it's not as painful as it would have been 6 months ago. Switching gears, probably the hottest topic in distressed multifamily is what's going on in New York City. Just to give a quick summary, you have borrowers who purchased apartment buildings, often with 2-3% cap rates, with the idea that they could turn rent stabilized buildings typically into free market rents. That all changed several years ago. Basically, you can't do that anymore. So you have a lot of buildings in New York that are essentially zombie buildings, and certainly operating costs and so on have gone up. What do you guys think about the New York City multifamily challenges?
Yeah, I don't really see much in New York City. I read the same things that you probably do, John. There's not only New York, but a lot of places. New York suffers from rent control and rent stabilization more than other markets, although believe it or not, there's 182 markets in the country with some form of rent control. But there's a lot of people back in 21, 22 that bought at very low cap rates that right now are way underwater. And are going to have to sell or refinance or bring in equity or give back to their lender.
Yeah, I would say, John, I would add the phenomenon you mentioned in New York is probably happening across the country, but for different reasons in different markets. So, in some markets it's property taxes. In some markets it's insurance. In some markets it's operating expenses. And in some markets it's flat to negative rent. And some markets have the combination of multiple or all of those things. And so to the point you made, you buy it at a 3 cap. Well, that 3 cap didn't materialize. 3.5, maybe that actually was even lower because property taxes went up and they got adjusted, or your insurance is doubled. Insurance costs doubled. In a lot of markets that's happened. Your rents are flat. They didn't have the 3-4% growth you underwritten, or your other expenses went up. So there's a lot of that goes into that. And I think because of that, you go from this euphoric period in 2020, 2021, where people were looking at everything going up and to the right on the revenue side, income side, and flat on the expense side. And I think both of those things probably reversed. And so to your point about zombie buildings or what, there's just, or to Neil's point, there's a lot of buildings underwater for that reason. The rent control thing is a whole kind of idiosyncratic New York kind of phenomenon, but also maybe some West Coast markets as well. But there's a lot of factors here.
It does seem like regulation is coming to multifamily. I know we talked on our pre-call. What other type of onerous regulations are being proposed or implemented?
Affordable housing. Oh, sorry, go ahead, Ryan.
I was just going to say, the agents, Fannie and Freddie, have not imposed a lot of any regulations on their own, really. But what they've done is they've started to award affordable deals, and so they do an AMI calculation, and if a property based on their formulas is affordable at 80% of AMI, they offer rate discounts of 20 up to 40 basis points difference. And that's a one-time test. It's not an ongoing covenant on the loans. There are programs where you can agree to set aside units and offer rents at certain AMI levels of AMI and receive additional pricing benefits from that. But that's been a very successful program of the agencies. And in fact, they're offering 35-year amortization calculations on some of these affordable deals in order to boost the proceeds up a little bit more. So certainly rent affordability is a hot topic within the agencies right now, and something that they're trying to tackle.
Yeah, I would agree, John. Where I see it on the development side is an affordable housing regulation, certainly sustainability, energy efficiency, sustainability regulation on what you're building. In some markets, it's more around weather, hurricane code, things like that. And then, the more extreme levels, it's rent control that you're seeing on both the kind of the East Coast and the West Coast.
So more municipalities are adding rent control, or is it just?
I think that there's a combination, John, of kind of the carrot and the stick. So the stick is rent control. There's a lot of municipalities that are talking about or have certain rent restrictions. You can only raise so much. You've got to give more notice to borrowers. There was a lot of forgiveness during COVID because people had lost their jobs, and some of that has stuck with it. But the carrot is that there are various municipalities that are trying to solve the availability of unit problem, which affects pricing, by certain incentives. And, if you want, I can discuss some of those.
Yeah. We'll get to the incentives in a minute.
Mm-hmm.
In Chicago, for example, if someone acquires a foreclosed building, they have to either offer a new lease to a qualified tenant, or they have to pay them $10,600 to relocate. So that can obviously get pricey for a building that's distressed. Roger, we talked in our pre-call. This was news to me, but the yield pricing, which has enabled a lot of the rent growth we've seen since the global financial crisis. Landlords, for the most part, have taken a lot more meat off the bone, and they've in a lot of cases don't renew leases because they want to get 5, 8, 10% bumps. What's going on? I understand they're cracking down on that.
You're talking about just kind of the desire to churn tenants and grow rents versus keep them
yield
longer.
Pricing.
Yeah. So look, I think this has to do with a market structure that was created by the GFC, in where we lived in this zero interest rate environment for a long, long time until this last couple of years, and because of that, the business of multifamily turned from, for many, not for all, but turned from a business where you're making a lion's share of your income from cash flow and a component of it on the residual, on the sale, on the exit, on the reversion. And I think you turned it into a business for many, particularly on the development side for sure, but even on the acquisition side, where it turned to a business where you were making the majority of your income on the reversion. And what that means is you don't care about the operating expense of turning tenants quickly if you can capture the rent, because your hope is that you can exit the deal at a higher income and convince a buyer that then they can just keep their tenants in longer and enjoy the income, and hopefully have positive leverage. And of course, that didn't exist for a while because you got the phenomenon that you mentioned, the 3-cap, 4-cap buyer, when your long-term rates were still at 4%. Plus, you had to grow into positive leverage. And so it was all because of a structural issue where the way to make earnings because of the demand of housing, of purchasing, and the supply of capital, I should say, and the zero interest rate policy that created this environment where people were looking to make money in this business on the exits and not so much along the way.
But so you mentioned on our pre-call that you can't even share apartment rents with other landlords now, and so it's more of a guessing game?
Well, that's another issue. That has to do with a lawsuit that was filed around collusion because there was kind of there's been a sharing of information over time in lots of industry, including multifamily, and where managers will share information about where their rents were and how occupied they were, so that people can make decisions week by week on where their rent should go. And then there's a lawsuit, and now that we're in this kind of no man's land right now, sharing information, and there's ways that you can do it where it doesn't, identify properties and things like that. So I think the industry will find its way around this issue, John. It's really about data and information, and I think all good, successful kind of liquid markets need data and information. The way we used to do it before there was technology was to go and just shop and call all of your comps, and we probably are still doing that today. But I think good sharing information is a good thing for the industry. So hopefully they'll get around this issue. I don't know, Neil. I think you had some color on this as well.
So John, there are companies that provide this data, and there were class action lawsuits against them, saying that landlords were colluding to increase pricing based on this data. So as a result of that, people are being more cautious right now.
Yeah. Well, whenever I have a question about a complicated tax credit deal, I always call you, Neil. It sounds like, with rates dropping, are you seeing more interest in those programs? What's particularly hot? Obviously, opportunity zones were a hot topic a couple of years ago. Can you give me some color on what you're seeing in that world?
Sure. So, the main program since 1986 was created, the Low-Income Housing Tax Credit Program, and that provided units mostly for AMI of 60% and less. It's a very competitive program, state by state. On average, there's a little over 100,000 units a year that are built in this program. Since the beginning, it's over 3.5 million units. So there have been a lot of units. There's some problems with this program, though, because they benefit the lawyers, they benefit the developers that get the allocation. So they're spread out. Typical unit size is 80 units, which is very small. Used to be in some markets, it's 30 or 40 units, and the prices are very high to produce these low-income units, low rent units. It can cost $600,000 or $700,000 a unit. So opportunity zones is one area that investors have looked at, where you can build larger scale units in low-income areas. And not pay tax on your gain on your new gain for 10 years. So you basically can put your old gain into an opportunity zone investment, build or rehab, and then, for example, if you put $1 million of equity and then you hold it for 10 years and that becomes 5 million on the sale, the other 4 million, there's zero capital gains on these opportunity zone investments. The other thing that's happened is to try and mitigate the affordability rent issue. There are several states, one being Florida that has a program called Live Local I can go into, one being Texas that has a state bond program, and third being Idaho, where they have a zoning relaxation. Just as an example, Florida, they approved this program called Live Local, where you can produce new units up to 120% of AMI and you can get higher zoning levels. If you do 40% of your units up to 120%, not only can you get better zoning, but 75% of your real estate taxes are basically exempt. So that means if you're paying 4,000 a unit in real estate taxes, it's now 1,000 a unit. So you've just saved the tenant, you've saved yourself $350, $400 a month in rent, which you can offer that reduction to the tenant. Therefore, there's more units that are going to be built closer to where people live and work.
Brian, are you seeing a lot of those types of deals hit your desk on the permanent market?
Yeah, the tax credit market's certainly active. Neil mentioned one of the programs in Texas. There's a PFC program where they freeze the property taxes, and that's been a very it's gone through a couple of iterations, but that's been a very popular program and an effective way to promote affordable housing.
Yeah. Well, you're right. You also have some visibility on building operating costs because you probably look at more apartments than most people. Obviously, we've talked about insurance in Florida and Texas. I mean, is there a crisis in insurance yet? And maybe you could touch on some other elevated operating costs as well.
Yeah, I think the big ones are taxes and insurance. Property taxes have keep going up, and assessors have been more active in reassessing properties and increasing the tax basis. And we have started to see in October, I think, is when the final taxes are going to be coming out in Florida, and we've seen a number of preliminary proposed assessments coming in lower. So I think there's starting to be some relief there. Insurance, I think, has stabilized, maybe improved a little bit. It really got out of control last year. I mean, we had $2,000 a unit for large apartment buildings used to be a high number, and then we saw 3,000 and 4,000, and I heard of one coastal high rise at 6,500 a unit insurance costs. And so I think that's certainly an outlier rather than the norm, but that the higher taxes and the higher insurance costs certainly plays into the affordability of the tenants, because those expenses have to be passed on.
Raj, Neil, anything you want to touch on the expense side?
No, I think we hit it well. I think insurance is a huge issue, and you named it, Florida and Texas in particular, but across the country. And then taxes, yes, local, municipal. I think it seems like with, particularly with resetting of values in a lot of these markets, again, going through kind of this price discovery process, there's finally liquidity in markets. You're starting to see sales. You'll probably see taxes go in the other direction for a while, which is good.
Yeah.
I think on the insurance front, it just depends. But to Ryan's point, this year was better than last. Hopefully that continues, albeit,
Yeah, just one comment on insurance.
Yeah.
The state of Florida passed legislation limiting the amount that lawyers can attack insurance companies, and as a result of that, this year premiums have started to moderate when they were going up exponentially because of a lot of insurance fraud. So.
Yeah. We did get a question from Tyler Clinch, directed to you, Ryan. What are the current cap rates that you are seeing for multifamily permanent financing?
Well, I think I've still seen a couple sub 5 cap rate transactions, but I think that's more the exception than the norm. I'd say for Class A multifamily properties, probably in the 5 to 5.5 range. And that might be a little optimistic, but that's where we're trading. I'm sure buyers like it higher and sellers would like it lower. And then as you go to older BC quality properties, that's really where we've seen the most cap rate expansion. I think or in certain markets too. I mean, in Chicago, there's been some Class A properties that are 6.25 cap, and these are newer construction high-rise properties, and those 5.25 are the Florida markets where there's still a lot of investor demand. But that BC quality property, that's 6.5 to 7.5, 8 caps, I think, right now. I see there's a question there in Texas. Again, that's it's probably at 6.25 to 7.25 cap rate, maybe. And I think we do a lot more refinances than acquisitions, and I think appraisal cap rates on refinances are generally a little bit lower than what the actual trades in the market are. There's a lag between the appraisers' comps and where I think we might be at an inflection point now, though, where given what we've seen in rates come down, I think that should push down cap rates.
Yeah. Yeah. Before the global financial crisis, we saw, particularly in Chicago and a lot of markets, we saw a lot of condo conversions in which people would convert, typically older apartment buildings into condominiums. And then we've seen since, 2010 or so, it's been the opposite. New condo buildings have been bought up and turned to apartments. Now with the housing shortage, particularly in many major cities, people haven't really been building condos in major cities for a while. Are we seeing, more condo conversions again play out? Rajan, what do you think?
It depends on the market. I actually happen to be doing one in Chicago, particularly because I feel like there's this lack of inventory for what I'm calling an affordable luxury under $1 million product. I think the problem is that, in some markets like Chicago, as an example, to build something new, it's costly. You probably need to sell it over $1,000 a square foot, and you have a secondary market that trades, for relatively new product in the 500s. So it's a big gap between what you need to sell for and what the current market is showing you. That's Chicago. There's other markets, certainly like Miami, where I spend a lot of time, and it's a different story there because of post-COVID migration patterns and a lot of foreign capital in that market, where you've gone from a $800-900 market to a $1,500, $1,600, $1,700 market for kind of average product. The high end is trading in 5,000 plus, north of New York City. And so it's just a different world. And there's a lot of condo being built. So it just depends. I do think there's an opportunity for conversions to come back in the markets. As rents continue to grow, I think affordability in rents in certain markets start becoming concerning. And if people want to live there in somewhat of newer product, I think these conversions, particularly those where people, developers are spending time, energy to really redevelop these to look and feel brand new, I think that there's a real market for it. And so you might start seeing some of that, particularly as interest rates come down. I mean, you showed that graph where you may be kind of neutral of whether to buy or to rent based on, your monthly cost. But then if you look at that graph again, you say, well, every year, the cost of product goes up. So there's an appreciation component that's really not built in to that graph, that if you say, all right, I'm actually making money by buying any one of those years. If you would have bought, you would have actually been better off than renting. And so even though I'm a huge believer in the rental business, obviously we build apartments, and I think that there is a huge need for it and people like that way of living. I think coming back to this idea of actually owning something and building home equity is something that may have been lost over the last, cycle, that may be coming back. And I do see it more and more in different markets. It depends on the market.
Guys, have any thoughts on that?
There's still a lot of renters by choice. I think I certainly agree with Rajan, and there's, I think, some pushes for home ownership and benefits to it, certainly. But, as multifamily developers have expanded the rental product, they're now offering these build to rent, they're calling it, which is single family homes and highly amenitized complexes. And that's becoming a popular alternative too for renters who want more than just an apartment.
Let's pull up the poll question. In which region is multifamily most attractive currently? And let me know if you can bring that up. The Northeast, the Midwest, the South, the West.
All right, awesome. It's launched and in the chat.
Who wants to go first? Ryan?
What's Nana, do you want to close and tell us what the results are, since I can't seem to see it on the screen?
If you could pull up the chat, you can check it there. I'm just going to give it 1 second. We still have some responses coming in, so I'm going to give it 1 second for people to answer. Okay, cool. It looks like some responses are still hitting.
There we go.
While we're rating, Ryan, what do you think? Where do you want to most lend or buy right now?
I mean, I think it seems the most investor demand is in the Sun Belt, Texas and Florida. I think a lot of those markets, though, there's even Austin, Nashville, Denver, some of the hottest markets. Denver's not in the Sun Belt, but all throughout Florida, really, there was so much supply added in the last 2 or 3 years that there's kind of this absorption. I don't want to call it a problem, because there's still positive absorption in these markets. I think concessions have been a little bit stickier than they thought, and the lease up maybe a little bit slower than anticipated, just as all this absorption is going on. But everyone I talk to's outlook, and certainly mine, is that we're going to get through this. The new supply is dramatically slowed down as there's been a reduction in new construction. And those are the markets, the Sun Belts, that is experiencing the best population growth, and that just means more renters. And I think I'd say that's most of the deals I'm seeing in the investor demand. It's still that kind of Southeast in Texas.
Anna, what's the final result, if you could pull it up?
Yeah, so the final result is Midwest got a 55% vote, South got a 35% vote, and West got a 10% vote. And we didn't get any votes for Northeast. Yeah, right?
Well, Rajan and Neil have moved their Chicago residency to Florida, so at least on this panel, we've been going south. Rajan, how would you compare development opportunities in your backyard versus Chicago or other older cities?
Well, I think to answer that question on like where you would want to lend or buy today, I think short term you're probably going to see the Midwest fare the best. I think long term you want to be in the South, the markets that Ryan mentioned, because to his point. And then my answer to that question, where can I get the lowest basis? I mean, the reality is, like, I would be in all these markets. It just depends on the basis you want to buy at. And if you could buy a 6.5 cap in Chicago, that might be a really great deal. Probably 50% below replacement cost, or more in some cases. But the reality is, like, long term, the South and the Southeast are continuing to grow. And I think if you can find some barriers in some of those markets, those feel like the best places still to develop. So from our perspective, that's what we like from a development perspective, long term.
Yeah, I mean, I would agree. I think that I've done a lot of business over the years in Chicago, and I don't know who would build a multifamily in Chicago. Union labor regulations, taxes that keep going up without reason. I think that as opposed to just the region, it's really market by market specific. What are the demand generators? What are the costs to build? What do you think the exits are? But certainly Florida and the Southeast, and again, places like Nashville, they've been growing. The cost to build, if you can find land, is not that great. And now you've got this Live Local program in Florida that is pretty favorable.
I will just say, from a lender perspective, John, though, the Midwest is a very attractive place. I think certainly Neil mentioned downtown or Chicago. That lack of new supply is a positive for the market. The Chicago suburbs have done really well. Smaller markets, after like the Des Moines, Madison, Columbus, Ohio. Columbus, one of the hottest markets actually, have done really well. Even up St. Louis, Kansas City. I think very stable rents, not a lot of new supply because everyone is chasing those opportunities.
Right. Because there has been new supply, rents are going up in those markets, including Chicago.
Well, I mean, it does. I mean, we are certainly hearing about some distress in multifamily, particularly in some of these hot areas where, you know, the trade to move from the Midwest, Northeast to Texas or Nashville or Florida, in a lot of cases, it may be a cost increase to move to the Sun Belt. I saw somewhere that DFW, the average home price in DFW was now more expensive than New York City. So, you know, on that distress topic, I mean, is there a wave of distress in multifamily coming, or does it just seem like these loans are just going to get pushed out long enough for demand to catch up with supply?
One comment I'd make is I wouldn't turn my back on the Northeast. And when you do a cost of living, when you become cost of living neutral or even negative in what you just mentioned, it creates a huge. I mean, it's a big component of the benefit of moving that changes the calculus of when you should move. And there's a lot of these markets that are overlooked that are now, you know, you look at, you know, you see these pop up sometimes from time to time, like, oh, you could build, you know, buy this home in some random kind of Northeast suburb at, you know, 30 cents of what you could buy the same home for in somewhere, you know, in Florida and so, or Texas. So you're starting to see that change in the cost of living advantage. Certainly there's the weather advantage and some other things that you could still benefit for. But I do think that neutralizes a lot of things when you think about migration of people. And it's Northeast is so dense. So I wouldn't turn my back on it. And then my quick comment on the distress is it's happening everywhere. Just depends on why. We talked about a few of the factors that create distress. A lot of it have to do with kind of underwritten projections that didn't pan out, whether that be in revenue or the expense side. But we're seeing it, and it's more, a lot of it's capital markets related. So with rates coming down, some of that eases a little bit.
Yeah, I think you are seeing some distress. Even some big operators have given some properties back to their lender. Now, I think that's because they bought them too expensively and rates were high, and there's just this gap. They didn't want to come up with new money. But I think in multifamily, you will see some distress opportunities. Obviously, not the same kind of levels you have in office and some other assets, but you know, I think there will be some opportunities in tougher times, higher rates. Buyers to real estate tends to go into stronger hands. So I think you'll see some weaker people losing properties or selling properties, and some stronger people buying and holding.
The distress that I've seen, I really haven't. I haven't seen many distressed opportunities. I know I keep or acquisitions. I would keep hearing about it. A big difference in what I'm seeing is people coming and to me for a loan, and they have a $40 million construction loan, and I can get them $35 million, or you know, it's closer to $40 million. So it will require some cash, but that property's still worth $60 million. Where in 2009, 2010, people were saying, I got a $20 million loan. And it's like, well, your property's worth $15 million. So it's a big difference with respect to, I think, the opportunities in distress. Certainly, if you had floating rate loans and people who got aggressive debt fund loans, you know, a real high leverage floating rate, and they were paying 2.5%, and now they're paying 8.5%. That's eating up a lot of cash flow, and that's a distressed opportunity. But I think, you know, I was on a Fannie panel recently, and they said they estimated that apartment property values are down about 20% from the peak in first quarter 2022. But then they quickly stated that they were up. That at that peak was a 20 basis point or 20% increase in values from a year earlier. So we're kind of back to where we were.
Well, if you have permanent rates at 5% or so, if you can't make it work at that, then you shouldn't have been in the business.
Absolutely. Getting towards the end, if anyone else has any questions, please hit the chat feature. But, you know, on a general topic here, any thoughts on how COVID has changed multifamily? I know, Raji, you've done some small unit sizes. Obviously, some downtowns have gotten hit. Any color on what COVID has changed this market?
I can go first. I think, it's probably more on kind of operational process and like disaster recovery kind of things in our business now. Like, I don't think we think about COVID a lot in our business today. I mean, we went through it. It was tough. To your point, we have buildings that have small units and big common area spaces, and we had to shut them down and all this stuff. And we went through it. And certainly we talked about, HVAC systems and what you would do in the future. And you're trying to proof yourself for another kind of event like this. But I would tell you, we don't spend a tremendous amount of time. Maybe we did 2 years plus ago, but thinking about it. And I do think that we've made a lot of process improvements on what to do if this were to happen again. And it's in our operating documents and in our process documents and all that stuff. But I don't think we spend a lot of time thinking about it.
Yeah, I think it's more, what I've seen is more migration issues. There's more people working remotely, maybe, 2 or 3 days a week. So there are people take the train from a more rural area, and some people are coming to an office once a week, a month, and they're living out in the mountains or on the beach or, somewhere that's not as crowded and not as expensive.
Bob, you want to? Oh, Ryan, go ahead.
I was just going to say, I mean, I think it's not something that we talk about much anymore either, but I do think the lasting effect has just been the revitalization or attractiveness of the suburbs and from downtown. I think that it's kind of the migration out of the cities that has really spurred a lot of the suburban development across the country.
Hey guys, that was really enjoyable. There's a lot of lenders on the call. We follow the USDA programs. Last year, USDA allocated $39 million in loan guarantees, and that's million with an M, for rehabilitation for multi-housing. I guess my question is, have you run across an attractive program at a state, county, or city level for lenders on renovating/building multi-housing that I don't know of any? I'm just throwing it out there. Have you guys run across anything?
And the only thing I could think about is, again, what Brian was talking about, the PFC program in Texas. Basically, you don't have land costs, you have no real estate taxes. So the developer basically is building for the city, but they keep the cash flow. And you can, some of those programs, you can get a 4% tax credit on top of that for renovating. And again, the Live Local program in Florida, same thing. You can improve your density and lower real estate taxes. It's more market rate financing, but it gives opportunities.
There's a lot of
renovation.
There's a lot of incentives for green in SBA, rural, state of California. Does that flow over into this market?
Yeah, I mean,
I'm over two. Okay, that's a no.
Most of it, the stuff we've seen has been on the tax side. So we've seen, we have something in Ohio, in Cleveland, and there's a lot of property tax abatement. There's credits. There's a lot you can get in the form of city, municipal, and state credits, and they're mostly somewhat abating or discounting your property tax for a period of time. It could be through a TIF or something else as well. We have something like that in Phoenix as well on a long-term abatement. So there, it's mostly where we play in that is mostly incentives we're looking for related to property tax.
Well, the other thing is that there's a lot of office buildings that don't work anymore, especially in big municipalities, and a lot of these buildings are at least 50 years old. So historic tax credits is a big item. Some municipalities are offering TIF for people who will do affordable housing, converting these buildings from office to multifamily. So that's another thing that we see.
And my last question is a broad question. It's always a topic that is under the subsurface, and that's rent control. Do you see that as picking up steam? I guess my analogy is, excuse me, is wages in the fast food industry. Everyone was concerned about that 5-6 years ago. Now we're not. Is that a trend that lenders should be worried about in this market, or is that just going to stay under the surface?
Yeah, I think
There's
it's
a lot of pressure
affordability.
out there to, I think, to implement these programs, and I think they're misdirected personally, and it would be there's a lot of evidence out there that it doesn't work as planned. It's not something that we're planning for or cautioning, that we're structuring around.
Okay.
But
Fair
yeah,
answer.
without capping expenses, if you cap one side of the income and you let expenses go, that certainly creates problems.
Well, I think this audience, you're speaking to the choir. I'm just concerned. I'm not concerned. I'm just interested always in that. And I don't know how these topics gain national steam and national trends. And I think your answers are, we're not worried about it too much. So that's good.
I
Well,
think
those are my.
A lot of people are talking about the election. I think that it could go in different directions depending on the outcome of that.
Absolutely. Excellent. John, those are my questions.
Bob, take us away.
Excellent, gentlemen. Hey, if you want to see this video or share it with someone, it is on our YouTube channel under Coleman Report. I will throw it back to you, John. I know that we're talking about a topic for end of October, and what is that?
Yeah, so October 29th, basically 4 weeks from today, we'll be doing a banking webinar where we'll cover basically all the third quarter earnings from banks and trends and what we're seeing in the industry. So it should be another great event.
Yeah, we will publicize that as well. Thank you all for joining us. Appreciate it.
Yeah.
Thank you.
Thank you.